way more in the future, and I think it will be way more violent than we're used to. The biggest bull market in commodities we've ever seen, and that's only maybe not the first inning, but the second or the third inning, so we're very early, I guess, in this game.
Portfolio allocation aspect of the conversation, summing everything together, what are you advising clients to look at or consider right now when it comes to allocating assets? The world is broken up into different blocks or tectonic plates. These tectonic plates are shifting, colliding with each other right now in a fourth turning environment. We'll examine what this means for global order, more violence, unfortunately, and much, much higher inflation, and certain assets will rally tremendously. We'll reveal which ones. This is all according to our next guest, Philippe Gijsels, Chief Strategy Officer at BNP Paribas Fortis. Mr. Gijsels has been on the show before. Check out our last interview link down below. And he's the co-author of The New World Order Economy and 5 Trends, Investing in Times of Superinflation, Hyper-Innovation, and Climate Transition. We'll be talking about these themes, superinflation, hyper-innovation, and climate transition, and what this means for investors. And of course, we'll be going over what's going on this week with central bank policy transitions as well. Thank you very much for coming back on the show, Philippe. Good to see you again.
Thanks, David, for having me.
I understand you're currently in Europe. So let's start with news coming out of Europe, and then we'll talk about commodities and the world industrialization aspect and the New World Order. So the ECB kept rates unchanged last week. How do you think that's going to impact other central banks expected to announce their own rate decisions this week? We're speaking on the 16th of September.
Well, I think indeed it is a little bit risky because the Fed is going to be tomorrow, but okay, it's more or less all clear for 25 basis points, even if Donald Trump maybe wants some more, but I guess maybe it would not be a very good signal to do more than 25. Now, of course, this is the first of a series, 3 probably, potentially more. And honestly, the US economy has been slowing quite a bit the last couple of weeks. Quite a bit of weak data points in the job market, the beige book, and others. Of course, ECB is on hold. They told us, they said risks are balanced, so that's ECB speak for saying we're not going to move a lot. But Mrs. Lagarde kept the door open by saying, okay, as they always do, it will be data dependent, so they could go either way. And I still believe that the world economy is slowing and that we will see quite a bit of stimulus coming in from the US, the Federal Reserve, and that eventually, if the Fed cuts enough, maybe the ECB will cut also a bit, even though the European economy is quite strong, because I think that everything that's happening in Germany with the fiscal stimulus that's coming in, it has not got enough attention in the media, and I think this is a very important point. So, but all in all, a very loose monetary policy, which is constructive for markets overall.
This is from the ECB website. The new ECB staff projections present a picture of inflation similar to that projected in June. They see headline inflation averaging 2.1% in 2025, 1.7% in 2026, and 1.9% in 2027. Interesting how they're not projecting higher inflation because of the trade war. Can you comment on this?
Yeah, indeed. So I think inflation, when you look in the US, it's more like 2.8, 3.0 somewhere, maybe a little bit higher. So yeah, that's too high for the target. So if you have the Federal Reserve that cuts, well, you're above target. So that's already a little bit strange or scary. Now the Europe is clearly predicting around 2, which is their target. I think this is overly optimistic. Now, if you look at tariffs, they will mostly impact clearly the US itself, the consumers, so their prices will go up more. In Europe, you also have the element that the euro is strong, so that's also helping inflation, I guess. But overall, and that's one of the big theses in our book, The New World Economy in 5 Trends, that we predict structurally higher interest rates, and then talk more about the long end of the curve, interest rates, and also structurally higher inflation. So I think this is maybe an underestimation of inflation. Now what I think, and that's very important in this environment, and therefore it's a new world order, I think clearly that the central banks will err on the side of cutting, that they will focus in their mandate more on the economy and less on inflation. So I think what they do now, they're already sowing the seeds for more inflation down the road, which is of course good news for gold, silver, and other things.
Okay, we'll touch on gold, silver, and commodities in just a bit. Let's move on to global growth now. This came in a few weeks ago. China's shipment to the U.S. or shipments to the U.S. plunged 33% in August. Overall exports growth hits a 6-month low. Imports from the U.S. also dropped 16% from a year ago, customs data showed. Now, you have highlighted that China is perhaps already in what's called a balance sheet recession. Do you think this news accelerates that view?
Yeah, the balance sheet recession, of course, stems from the housing market. A lot of people saved a lot. They put a lot of their savings into the housing market. The housing market collapsed. Chinese feel poor. They don't consume. They don't invest, and they will save even more. So that's where the balance sheet recession idea comes from. On top of that, if exports are weak, because you can try to export your way out of trouble, but if that road is blocked, you have another issue. So that makes the situation even worse. So I think that the Chinese economy is fairly weak. Now what they will do, and we know that from the experience we had in Japan, and their real estate market went bust somewhere at the end of the 80s, and it took them about 40 years or more to crawl out of that. So in a balance sheet recession, lower interest rates just don't work. We've seen that in Japan. So the only thing is, and I'm not a Keynesian, but the only thing that helps is good old Keynesian stimulus, and that's what China will do eventually, because they cannot afford to have 30, 40 years of weak growth, because their society will not tolerate it like it was tolerated in Japan. So they will stimulate. That will help the world economy, will help growth as well, together with what the central banks are doing. But once again, it's also inflationary, and once again, it's good news for commodities. So a lot of arrows point in the same direction, I would say.
Well, just on that front, you said the stimulus may be inflationary, but don't you think China's slowdown may be deflationary or disinflationary? Maybe they could export some of that deflation to the West and force the Fed and other central banks in the West to cut even faster?
Yeah, absolutely. That's a very good point. And I think they have been exporting more than anything else, more than goods. They've been exporting deflation, and that has clearly helped. But if you look again at the figures that you've shown a couple of minutes ago, ECB is just at the target and probably underestimating. US is still above the target. So if you now altogether get central banks cutting in Europe and the US, you get fiscal stimulus on top of that in Germany, you get fiscal stimulus coming from China. Well, this will indeed make the economy move forward. This will help profit growth. So there are a number of very positive aspects to that. But the point is it will be inflationary. So if China goes from, and I totally agree with you, exporting deflation at the moment to exporting less deflation, or even start to export inflation again, that will have a massive impact on a global scale. So that's one of the elements why I think that a lot of central banks and also economists at the moment underestimate inflation for the coming years.
Before we continue with the video, let me tell you about a very important topic: how to protect your privacy. Now, your private information doesn't just live in the inbox of your phone. It's being collected, packaged, and stored and tracked by data broker websites all over the internet, even without you knowing. That's where today's sponsor comes in, Delete Me. I use Delete Me to protect my privacy, and here's how. It helps you. It's a platform that helps you remove your personal data, like your name, address, and contact info from hundreds of these data broker websites. When you sign up, you'll get a detailed privacy report showing where your data was found and what's already been removed. And Delete Me keeps working throughout the year, scanning and clearing your information regularly. It's an easy way to take back control of your digital footprint without trying to track everything down yourself. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout to get 20% off of US plans. Link down below, or scan the QR code to get started today.
Well, your book is called The New World Order and 5 Trends, Investing in Times of Superinflation, Hyper-Innovation, and Climate Transition. Now, you said offline in a note to me that you wouldn't change a single line if you had to rewrite the book. In fact, many of your predictions may be coming true. You think we're living in a fourth turning kind of environment. Can you just elaborate on what exactly that means? And yes.
No, sorry, excuse me. Fourth turning, indeed, this is a term that we borrowed from Neil Howe. It's the book, The Fourth Turning is here by Neil Howe. And he's an historian, and he puts things in a historical context. So his reasoning is, and I tend to agree with that, is that basically every 80 years, you get a fourth turning. For four turnings together are 80 years, and a fourth turning is more or less give and take a year, 20 years. So now the last fourth turning before this was the Second World War. And then, of course, you have a lot of destruction and then pain and horror. And then people say, hey, we're never going to do that again. And then you start to build United Nations and the European Union and climate accords and trade organizations and health organizations. And then, of course, unfortunately, after 80 years, and that's as we speak, people who have lived through the previous ordeal are very old or unfortunately dead. And then the cycle starts again. And what Neil Howe does very well in this work is putting things in perspective, because if you look at the news, it's all horrible, but it looks more than anything very random. Quotes in every direction, wars, people in the streets, left wing, right wing, everything. And you say, yeah, this is a world gone crazy, a world completely random. How can I make sense of this? But if you look through these glasses, and I can everybody recommend to read that book, through these glasses at the world, and you see, yeah, because a fourth turning is unfortunately a period of civil wars, of a center everywhere that gets smaller and smaller, and is unable to make the decisions to cut the budget or to get the budget in order. Extremist parties on the both sides that win. Sitting governments, sitting presidents, sitting parties are voted out basically everywhere. And what Donald Trump is doing is, of course, destroying a lot of the institutions, or trying to destroy a lot of the institutions that were built in the previous cycle. So yeah, we will have to go through this, and this means that we will have a lot of geopolitical volatility. And in our world, of course, this will translate in volatility, in euro-dollar, in rates, in everything. So I think a lot of things are coming through. And when you listen to serious podcasts and then serious interviews, this fourth turning idea was not that present, let's say, a couple of years ago. But people start to talk about it, and I'm absolutely convinced, unfortunately, that's the world we're living in today.
What are some of the effects of this fourth turning? Let's talk about Europe first, because you're based in Europe. Do you think the European Union will last as a coalition?
Well, that's a very difficult question. And being a European, I can only hope it's not the case. But it's clear we can no longer kick the can down the road. So we have come to a fork in the road, and we go either left or either right. And as a European, I hope, but that's more a hope than a prediction. Or a lot of other things I will be saying will be predictions, which I actually believe. But this is more hope that at a certain moment in time, in 15 years' time, we will say, hey, Donald Trump was probably the kick that we needed to get our house in order and to come together as a union, as a continent, basically, and try to resolve our own things, try to get more independent in terms of rare earths, to get our defense policy going, to get growth going, to get innovation going. And maybe that's the case, but it could indeed also go the other way. And that's the big question that's today on the table. And if you once again believe this fourth turning story or thesis, well, in the world of a fourth turning, it's extremely difficult for countries to work together, because everybody goes back to his own church tower and his own parish and everywhere. So it's extremely difficult, but maybe we will be forced to do it. And yeah, history will tell where we go. But I think Europe and the European Union is at an extremely critical juncture at the moment.
Europe is currently militarizing, with Germany wanting to build the largest army in Europe. Scandinavia is recruiting women, so on and so forth. The EU unveiled an $800 billion militarization plan in March 2025. What are the assumptions behind this plan? Why are they doing this?
Well, indeed, because you want to be independent a little bit from the United States. If you look at Germany, they exported or outsourced, we should call it, outsourced their defense policy to the US. They outsourced energy to Russia, and a very important export market was China. So all these three things fall apart. Germany is realizing this. I think Germany, and I will say it in German, they have the Schuldenbremsen or the Schwarze Null. That means that they could not run a budget deficit. Now they can. And like I said, this is a game changer for Germany and also for Europe, because it's like a Marshall Plan, a plan after the Second World War. It's a couple of times the German reunification in money. So this is hugely important. Germany still being the dominant economy, or the biggest economy still in the Eurozone, when they spend on military, and they indeed spend also on infrastructure, that will help. But I think that Germany has realized that we can no longer be under the umbrella all the time of the United States, and we will have to take fate a little bit in our own hands. And of course, if Germany leads, maybe some other countries like Belgium, where we're a very, very small country, of course, on the world scale, but basically we will maybe follow this lead. And maybe, like I said, in 10, 15 years' time, this will indeed be the moment that we say, yeah, we started to change things for the better. And also, I believe, and I would not call it European Renaissance because that's maybe a little bit too strong, but since the beginning of the year, we also see money flowing again to Europe, a little bit, yes, to the United States, to the UK, to other places. So have an independent, big, deep capital markets, a capital union, stock markets that do well, IPO market, M&A market, that kind of thing is, of course, also very important. You're probably maybe too young for that, but in my time I used to play Age of Empires, and then, of course...
Oh, I love that game.
You love that game. You would build these small armies and everything, but you need stones, you need wood, you need meat, you need gold also to build your army. And that's one thing. You need a healthy, strong economy to be able to build your army. That's basically it.
Well, people are talking about this bifurcation of the world where you have the BRICS forming an alliance, and then you have the US on the other side. Where do you think the EU falls in this bifurcation? Do you think the EU will trade more with China and Russia or the US in the future?
Oh, that's a hard one. I think there, once again, Europe is in a very difficult position because we have been under the umbrella of the United States for the longest time. And it's very hard because it's also it's not only trade, but it's also technology. If you get technology divided in different groups and different types, you have to choose a certain moment in time. Are you going to use telecom systems that are built in China or the United States, for example? So also there, Europe, I think, is in a very difficult situation. I think in the best of all worlds, you would trade with as many partners as possible, but that will basically not be easy. And I think the biggest problem, maybe, in Europe, even making an abstraction of the deficit and the fiscal problems you have in France and other places, is not the innovation, but the scale up of innovation. Because if you look at companies in the United States, they make them every couple of hours. They make a new $100 billion company like Palantir, which is even bigger at the moment. We've not built a company of that size, a new company of that size, for the last 30 years. So we have good universities, we have good ideas, we have innovation, but we are unable to scale up. And that's, of course, all the red tape and all the bureaucracy and everything that's here. So that's a major problem. But in terms of trade, you can hope that indeed we can trade with as many partners as possible. But we have to make sure that we don't become the museum of the world, because of innovation is not very strong anymore. People will visit Europe for our past, but not for a future, and that's an issue. But I think I also believe a little bit in a lot in the predictive power of markets. The fact that European markets finally get some momentum going is maybe the indication that at least markets believe that we have a chance of getting out of here.
Well, you've compared the global economy right now to a series of tectonic plates moving and possibly colliding with each other. Tell us about how this collision may play out. What does that mean?
Well, that means indeed you have the geopolitical uncertainty, which comes from the fourth turning. So you have the fragmentation of the world. Everything is going into blocks. So we had the Pax Americana. So after the fall of the Soviet Union, US was basically the only superpower. Now you have at least two, with China coming up. You have potentially India. And then you go to a world that's more normal, I would say, because only having one superpower is very rare. You can go back to the Roman Empire, 100 BC to 100 after Christ. Then Roman Empire was the only empire around, and then you had peace because there was only one very strong force. We had for 50, 60, maybe 100 years, especially after the First World War, Second World War, you had the United States. But now you have more countries, basically, and that's this also in this fourth turning, this fight between the new superpower and the old superpower. But you also see that on the economic side, because the world is fragmenting, and it's very hard for me to speak about the world economy. 10, 15 years ago, you could talk about the world economy, and then you could say it's expanding, it's going into recession. So they would all move more or less these tectonic plates in the same direction at the same speed. Central banks would do more or less the same. Now you cannot say that anymore, because Europe is maybe for the first time in quite a while going to grow faster than the US. Fed will cut, ECB is probably on hold. In Japan, the Bank of Japan is hiking interest rates. So these are all moving at a different speed, in a different direction. And like tectonic plates, they would move in the same direction at the same speed, but now they move in a different direction at a different speed. And this means, they will collide somewhere, and the collisions will create the volatility. And the volatility is what we see in euro dollar, where in my mind the trend has only begun. You will see it in the long end of the rate curve, you will see it in commodity markets, and you will see it in equity markets, where we had, of course, after the Liberation Day, the big fall in equities, which were of course made good for quite fast afterwards. But that type of volatile events we will still have way more in the future, and I think it will be way more violent than we're used to.
Way more violent, like physical, like kinetic war? Is that what you're referring to?
Well, on both sides. You will have, unfortunately, I hope nothing is going to happen with Taiwan, but you will have more wars and more pressure points on the geopolitical front. You will see economies being harder to read and being more volatile, and those two combined will make for more volatile markets. I think they go together.
The U.S. 10-year yield fell from the beginning of the year at 4.8%, now down to 4%. So the bond markets had a pretty good year, at least in the U.S. Which region in the world do you see the long end of the curve moving the most in the next couple of quarters?
Well, I think the big story, because you mentioned the 10-year, but the big story is more in the 20 and the 30-year, because there you see them going up. Longer everywhere in Europe, in Germany, in the US, in Japan as well. So I think if you have big problems in the bond market, I think it will start in Japan, because Japan has been running a deficit for the longest time. The debt to GDP is probably the highest in the world, and it was not a problem, and it's never a problem until it becomes a problem. But if all of a sudden you start to pay interest rates over that debt, you get in fiscal trouble with your budget. And I think this is in a way logical, and that's also what we describe in our book, because the very long end of the curve, and I know I'm oversimplifying things, but I'm still going to do it. There are two very important building blocks of the long end of the curve. First of all, it is the inflation expectation. So when you think that inflation will be higher in 10, 15 years' time, structurally higher than today, which we think, you will ask for a higher yield. And then, of course, you have the term premium. If you believe that maybe governments will not be able to pay back the debt in the long run, well, you will ask for a higher risk premium. And these two things are happening on the long end of the curve. So I think that the long end of the curve is telling us that this world is coming. Now, of course, central banks will not let it happen. They will cut the short end of the curve. They will do that. You have seen a lot of financing also on the shorter end of the curve to take money away from the long end of the curve to have less supply. I would not call it in the US yield curve control like they did in Japan, but still, I think if push comes to shove and we get into trouble, then they will try to control the curve. They will do, once again, quantitative easing if necessary, and so on. But the long end is telling a very important story, and most people look only up until the 10-year, and there everything looks rosy. You see normal behavior. But if you go beyond the 10, then you see what the market is thinking about the long run, and that's maybe not a happy story.
The 30-year rising in the U.S., what is that signaling? Higher inflation expectations or higher economic growth, or both?
Those two, and on top of that, a higher term premium that people start to doubt whether the US will pay back its debt in 20, 30 years' time. And that's a big thing, because we've all learned in school from our books of economics and everywhere, the US is risk-free, and everything prices from the risk-free. But if the risk-free is no longer risk-free, well, what does your model look like? So you have an issue, and everybody is talking about yield spreads being so tight, corporates over government bonds and high yield and so on. And you say, yeah, that's logical because people do not see a lot of risk in the market. But you could also say maybe they see less risk in government bonds than in government bonds. And that's also a way that the spread would be very low. So maybe we have to look at a new way with new glasses to this world. And if we see a low spread, it doesn't necessarily mean that people do not see too much risk in government corporate bonds over government bonds, but maybe they say, hey, maybe government bonds are for the first time in history maybe less risky than government bonds. So that's something I try to wrap my head around at the moment.
Let's talk about the dollar. Why do you think the DXY fell despite the long end of the curve rising? And as you said, the term premium rising. Shouldn't higher interest rates move capital to the US, not away from it?
Well, that's the logic you talk about over the last 15 years. When money would flow very easily towards the US bond market and towards US stock markets. And the outperformance of the dollar compared to the euro, but also to many other currencies, has been the fact that money has been flowing towards the US. I always say to clients, never believe a banker making a prediction about euro dollar because they're always wrong. But if you could look at it with hindsight for euro dollar, but for any currency you want to discuss, there are only two flows important. There are the trade flows, commercial flows, and then of course the investment flows. And if you look euro dollar, well, Europe has a trade surplus with the US for the longest time. So that means there is more demand for euro, less demand for dollar. That would push the euro up. But what we have done for the last 15 years as Europeans, as Belgians, we've taken our trade surplus, we have added our savings, and we put everything back in the United States, in the bond market and in the equity market, because that was the place to be. I always compare it to a candy shop. You had a candy shop, and you could only eat as an investor Nvidias and Apples and Microsofts, because all the rest, emerging markets, Europe, small caps, UK, you name it, they would all lag. Since the beginning of this year, this has changed because money has been flowing more evenly over the globe. They call it the end of American exceptionalism to a certain extent. You could also call it diversification to a certain extent. But it is no big surprise in my mind that as the European markets are outperforming and emerging markets are outperforming the US, that also has an impact on the euro dollar. So if you believe, like I do, that this money will float more evenly over the world, then you would also expect a weaker dollar. So I would not exclude 125. And if we talk again, which I hope in a year or two, I would not be surprised to see 130, 140, which also opens up opportunities for emerging markets, because I also think that emerging market equity will do well in this environment, and that even emerging market bonds and local currency will do well.
Did I mishear you? Did you say DXY is going back to 130?
Well, I would not be surprised to see that in the next I talk euro dollar, yeah.
Oh, okay. Yeah. All right. Well, okay. So your view on the dollar then, the US dollar, is it going to strengthen then from here?
Well, I think it could strengthen a bit, because if indeed you see a little bit more money flowing again to the US, but I think the dollar will weaken and the euro will strengthen, because money will no longer flow this easily towards the United States. And we tell clients, it would be a mistake not to be invested in technology. Even though the valuations are high, you do not want to miss the boat on AI. You do not want to miss the boat on quantum and all these things. And if you say technology, well, to a large extent, you still stay the US. So it would be, I think, a mistake not to be invested over there. But what we have been doing in portfolios since the beginning of the year is diversifying towards Europe, towards European small caps, towards UK stocks, towards emerging markets, and so on. So I think it will be more evenly distributed. And of course, you have, even as a European investor, you have always dollars in your portfolio. but we have been reducing that, and we've also been hedging our dollar exposure because, like I said, I would not be surprised to see euro dollar at 130 or more over the next couple of years.
The fact that the U.S. dollar has slid while the S&P 500 has risen, what does that signal to you? That capital has flown to a risk appetite environment, and so do you think this risk appetite will continue?
Well, the two go together a little bit, but it's not only what the S&P has done, it is also what the other indices have done, because the last 15 years, the S&P 500 has outperformed everything else, and that's mainly due to the Magnificent Seven, the big companies, the Apples, the Microsofts, the Nvidias, and so on. Since the beginning of the year, the US has done well once again, the S&P is up, but European indices are up more. If you look at the Euro stocks is up more, especially the Spanish stock market is up more, the German stock market is up more, even the Chinese stock market is up more. So that's what I mean, is that the outperformance of the euro, I'm not saying that the US market is not going up anymore, but it's not being so dominant as before. So it's very well possible that other stock markets will do better. And if other stock markets do better on a relative basis, this is always coincides with a weaker dollar as well.
Well, your book explores hyper innovation. Which area in the world will be most responsible for hyper innovation in the future? Maybe that could give us a sense of where capital will flow.
Well, there once again, Europe does not score too well, because I said we've not been able to create a $100 billion company for the last 30 years. So it's a little bit of a race between China and then the US at the moment. And if you see, of course, the amount of money that both countries are pouring into data centers, for example. I saw a graph the other day that about 70% of all the venture capital in the US goes to AI at the moment. So that will always, like internet, create a boom bust. A lot of these companies will go bankrupt and so on, but in the meantime, you will have a lot of innovation. So I think if you look at these new technologies, well, I think the amount of investments going in is the highest in the US. China is in the second place, so they will lead. You will need a lot of rare earths for that as well. China has them. Today there was only once again the news that I saw that the US will put $5 billion, which is a lot of money, but in the big scheme of things, not that much money. But in developing rare earths projects, Europe is also not scoring too well on that one either. So if you look where it goes at this moment, I would say that the US is still going to take the lion's share of this, followed by China. And it will be extremely hard for other countries to follow up, because these are massive investments. And then the people who build these data centers to put the money in AI, quantum computing is next. Combination of the two is extremely powerful. So I think that, it will be most of all US tech. So therefore, I still think it would be a mistake not to be invested there, even though valuations are high.
Let's talk about the theme of super or hyper very high inflation. I think you called it superinflation, not hyperinflation. My apologies. Superinflation. What does that look like in today's world? Is that a repeat of 2021? And second part of the question, which assets will we use now in 2025 and beyond to hedge against superinflation?
Well, I think when I sign off books, I very often write, it all comes and goes in waves. It always does. So these inflationary waves and interest rate waves attached to them, because they move together, tend to be waves of 20, 30, 40 years sometimes. So the last big inflationary wave started after the Second World War, which is no coincidence that this was the last fourth turning, then gained speed in the 60s, and especially in the 70s with the oil shocks, and reached its peak in 82. Then Volcker became president of the Federal Reserve, brought inflation under control, and then inflation came down until COVID somewhere. And now I think, we had a peak with COVID, which was of course an aberration a little bit, but I think with COVID we've entered a period where inflation on average will no longer be between 0 and 2, but between 2 and 4. And of course with peaks above that. So it doesn't have to be 10% each and every year, but I think that between 2 and 4 will be the new normal. And there are a lot of reasons for that. If you have a world of conflict, war is inflationary, piece is deflationary, so it will be more conflict. You will need a lot of money for the climate transition. You have the aging of the population. But most of all, the US has about 37,000 billion of debt. You have other countries in Europe and other places in the world. There's also a lot of debt. So the only way to keep this debt manageable in a certain way is to let inflation run. Because if inflation runs, in real terms, basically the debt weight becomes smaller. So when you have a mountain of debt, you can basically do three things. You can try to save your way out of it and grow your way out of it. That's in a fork turning extremely difficult because populist parties will take benefit of that. You can default. Let's hope that we do not go there. Or you can try to create some inflation, 3-4% instead of 2%, and in this way you keep the debt more or less manageable. But that's, of course, if you think about it, if you have inflation 10 years in a row on an average of 4%, you lose almost 50% of your purchasing power. So in this environment, cash is not an option. And if cash is not an option, then your question, okay, what do we need to own then? Well, the answer is real assets. And real assets are real estate, are equities, are commodities, are gold, are silver, are pigeons, wine, stamps, jewelry, whatever you can dream of, everything that's tangible, but not cash.
This is an article from Bloomberg, syndicated by Yahoo Finance. Gold could rally to almost $5,000 an ounce if the Federal Reserve's independence were damaged and compromised, and investors shifted just a small portion of holdings from treasuries to bullion, Goldman Sachs said. A scenario where the Fed independence is damaged could likely lead to higher inflation, lower stock and long-dated bond prices. The bank outlined the possibilities. $5,000 if just 1% of the privately owned U.S. Treasury market were to flow into gold. A lot of assumptions there. Why would the Fed's independence be compromised? Is that a view that you share as well?
Well, it's a hard one, but you see, of course, Donald Trump putting pressure on the Fed. He tried to get rid of Jerome Powell. Okay, that's not really working. Now he's working on some of the other voting members of the Fed, Lisa Cook, I believe, and others. So I think that in a way, we will be living in a world, and I tend to agree with the view that it's written down there, that we will live in a world dominated with fiscal dominance, I would call it. So you will have very big deficits, and you will use the central banks to buy back the debt, do quantitative easing, make sure that interest rates are low enough. So the pressure on the Federal Reserve, but also on a lot of other central banks around the world, will increase. So that's totally correct. And the other part, in this article, we talked about 4,000 in our book when gold was 1,800. Now we're not too far from that, so I think we will fairly quickly go to the 4,000, which will coincide with $50 silver, I believe. But that's only the start of it, because it's absolutely correct. Since the beginning of the year, investors are back in the gold market, but before, investors were net sellers. Gold went up because central banks were buying so much. They bought last year about 1,000 tons of gold, and that started or accelerated at least with Russia invading Ukraine and US blocking their access to treasuries and kicking them out of Euroclear and freezing reserves and so on. So this made a lot of countries around the world, also China notably, think, okay, we have to get rid of these treasuries and we buy gold. So the entire bull market in gold up until now, or at least up until the beginning of this year, it was driven by central banks while investors were absent. I think that investors only hold in their portfolios worldwide, and it could be off a couple of decimals, but it's about 2%. So only 2% of all the assets of investors in the moment is in gold, precious metals, or related assets like mines and so on. So if they shift only a little bit towards gold, which is happening as we speak, I think, well, 5,000, 6,000, 10,000, I think these are all levels that are possible in the coming years. And gold, silver, copper, rare earths, they're all real assets as well. So it has gone fairly fast, so you could not exclude that you have some pause here. And I think gold will pause at 4,000 and silver will pause at $50. But after that, I think it will go way higher. And much higher than people can imagine.
Well, what is the BNP forecast?
Well, the BNP forecast is always like banks, very prudent. We talk about 3,800 on gold, but when we reach 3,800, we will say 4,000, and when we reach 4,000, we will say 4,002. So we're going up in lockstep. So we have to be a little bit more ambitious and express something. So we've always talked. Personally, I've talked about 4,000 in our book already quite some time ago. And I'm sure it's not going to end at 4,000. So you name a figure, and I believe it.
Well, you're calling it the largest bull market in history. What makes this different from, let's say, 2011, when commodity prices like precious metals rose and then very shortly fell and stayed low for years?
Well, that's a very good point, David. And that the answer is, I think, because last time it was mostly demand-driven. It was demand-driven from China, getting in the WTO, industrializing very rapidly, having a lot of demand for copper and so on, and supply could not really follow. This time it's on the demand side. It's electrification for a lot of things, not gold, but silver, rare earths, copper and so on, because you need a lot of copper for your electrical revolution. But it's also supply-driven in the sense that because of climate change, people were not allowed to open new mines. It was very bad business for a very long time. Return on equities were extremely low, so nobody wanted to invest in the commodity space. And yeah, we've underinvested in the total commodity space. Only maybe China not, but all the other countries around the world basically have underinvested in the commodity space for the last 20, 30 years. And now they're catching up. But of course, a lot of these mines and projects, they have long lead times. It takes you 15 years, 20 years to open a new mine if you get the permits and everything. So if you look at soft commodities, well, it's about harvests. It's very difficult to predict. But with metals and hard commodities, well, you see the supply. And when I see the supply coming up over the next couple of years, and I see the demand that's coming in, well, it's not in equilibrium, so you will need massively higher prices. So in my mind, this is going to be the biggest bull market in commodities we've ever seen. And that's only maybe not the first inning, but the second or the third inning. So we're very early, I guess, in this game.
Which other commodities, we've talked about precious metals, which other commodities may benefit from this New World Order that you're talking about? Any base metals? Yes.
Yeah, absolutely. So I would certainly highlight copper. That's also what we talk about in our book. Because the point is, in our book, there is also a Bloomberg chart where we look at a consensus demand for lithium, for copper, for cobalt, for nickel for the next 25 years until 2050. But if you make a prediction like that, okay, you know it's going to be horribly wrong because the bars will be higher or lower or whatever, but I think they will be way up. But also the composition will be different because I do not know what the batteries of the future will look like, but suppose you need less cobalt and more nickel, for example, that will have an impact.
Yes.
I'm getting more bullish now on lithium at the moment. Lithium has been hammered incredibly. Also the lithium, the equities that go in the lithium space, they have been damaged, so they look like they're bottoming out. So on a very speculative basis, I would also buy lithium or lithium-related assets here. But the point is, if lithium is replaced one day by sodium or by natrium, well, you have another story once again. So that's hard to predict. And therefore, I feel the most comfortable, besides gold and silver, with copper, because if you want to move electricity from A to B, it's still copper. And if you look at demand and supply for copper, well, it's not squaring at the moment. So I think this is going to go higher. I love the rare earth space because the US is going to invest massively to get more independence from China in the rare earth space. If you want to win the trade war to China, it's very hard to do that if you have no independence in the rare earths. It will take time, but the problem is, as an investor, they're very volatile. These mines are not always very profitable, and it's also very hard to find investment vehicles to play this theme. But my first idea would be gold and silver, and after that, yes, copper. That would be the key ideas.
The last question, I'll let you go. So you wrote to me off like copper could double. So that is a prediction that you're making. But however, I'm wondering, Philippe, just on that note, perhaps we might see a disruption in the copper supply, which would actually help your thesis. Let's say if the trade war heats up between the East and the West, I'm not saying well, but let's say it does. China has already banned several critical minerals exports. China holds roughly 60% of the world's copper refining supply. Let's say they stop doing that and stop exporting refined copper to the world. Let's say they stop exporting the remaining strategic minerals reserves to the world. What will happen to the electrification agenda? What will happen to the AI race?
Well, that's extremely difficult for the West, and China is using this as a weapon very cleverly to get this way in the trade war. So, like I said, it's very hard to win the trade war against China when they have this capacity. They're very strong in Latin America and Asia in mining, but indeed refining capacity, they're even stronger. And recently, last couple of months, let's say a year, I think US is getting on board with that idea and is starting to invest massively in these new projects. And that will take time, but eventually it will help. But that makes a lot of these smaller, mid-sized miners a very good investment opportunity. Now, there is a lot of volatility going on because if you say copper, you say China, okay, there's refining capacity, but you also have Russia. But also have a lot of countries in Latin America, like Chile, Peru. They have a lot of supply. But what happens each and every time you have a political manifestation, they immediately block the roads to these mines. So disruption can come from a lot of places. So this means that we're in a very long secular bull market in these things, driven by the fourth turning, driven by the geopolitical uncertainty. How more uncertain these things become, the bigger the bull market becomes. And I think uncertainty is quite high at the moment.
Great. Thank you very much. Appreciate your time, Philippe. Before we go, the portfolio allocation aspect of the conversation, summing everything together, what are you advising clients to look at or consider right now when it comes to allocating assets?
Well, own real assets. So do not have too much cash. That's one thing. Own US technology, certainly, but look at diversification in emerging markets, in European stocks, and in other places. As interest rates are going to be cut in the US, and we worry about the long end of the curve, we invest in the belly of the curve 3 to 5 years because we do not want to be in the short end. And own some gold, own some silver, and own some copper, absolutely.
Great. Thank you very much, Philippe. Where can we follow you and learn more from you?
Well, mostly on LinkedIn. So that's easy. I'm on Twitter, but on X, I must say now, but I'm mostly on LinkedIn.
All right. We'll put the link down below so you can follow Philippe on LinkedIn. Thank you very much, Philippe. I enjoy the conversation as usual. Appreciate you coming back. We'll speak again soon.
Thank you, David. Speak to you soon.
Thank you for watching. Don't forget to like and subscribe.